Hello, ladies and gents. So now we're going to look at task B. Once again, we'll look at candidate A. So if we look at this, salutations, please see my review of the accounting calculations below. Candidate then says depreciation on the leased aircraft. The aircraft has correctly been split into the major components and depreciated separately as per the requirements of IAS 16. There, no benefit given because, that is correct. There's no need to comment on that because it's been done correctly. Then the candidate says the cost of the various components should be the cost as per the measurement of the right of use asset. I would require more information here to determine if the cost of the various components was correctly determined. So once again, why are you concerned about this? Perhaps if the candidate went along the lines of saying it might not be appropriate to depreciate the right of use based on components because you don't actually have the aircraft, you actually have a right of use asset. I'd be happy to give benefit for that, but this candidate doesn't go there. This candidate doesn't talk to that fact and rather just is concerned about the quantum of the value of the component. So we're not happy with that one. Then they say the depreciable amount is the amount excluding any residual value. The residual value is set at 20% for all components. We would need to assess whether the residual is appropriately set for all components. It is unlikely that the residual for all components is the same. I think perfect. There, candidate, I'm giving you the benefit because you've identified that potential mistake. Then they say further, as the asset is leased, it is likely that there is no residual value. Second benefit I'm giving the candidate because they've identified that leased assets cannot have a residual value. You can't sell them. Then they say the useful life of the asset should reflect the manner in which the asset is to be consumed by the entity. Further, the useful life of the right of use asset is the shorter of the useful life of the asset in the lease term of 10 years. No application, no benefit at that point. But if you keep reading, then they say it is noted that years is used as useful life. This might not necessarily best reflect the use of the asset, and flying hours may be more appropriate. Excellent. Candidate has given us a bit of a theoretical background initially, and then has gone to say maybe the depreciation method is not the most appropriate. And then it says, especially for components like engines. The useful life of the main aircraft and the engine is currently at 20 and 15 years respectively, which is more than the lease term, and these useful lives should be limited to 10 years. Excellent. Here, we are happy because the candidate has given us a theory of the shorter of the useful life and the lease term, and then they apply it to components that have been incorrectly treated in the calculation presented. Then they say the application of the straight line method is correctly implemented in the calc. We should consider whether the license costs can be recognized as an intangible as per IAS 38. So no benefit really there. Then they say the total maintenance cost is incorrectly expensed as per the calc provided. There's more detail. The maintenance cost should be split into 3 categories of maintenance and treated separately. Routine maintenance and minor repairs should be expensed as this is the part of the day-to-day operations of the aircraft. Excellent benefit for identifying the appropriate accounting treatment for the routine maintenance. And then for the next 2, which is the major inspections without replacement and the overhauls, the candidate tells us that these should be capitalized to the right of use asset. So we then look at those together and say, okay, the candidate has identified the capitalization principle of some of these maintenance costs. So definitely giving a benefit there. Then they also tell us that we should consider whether there is any provision to be raised at year end. There's definitely no provision, so that's technically not correct. But if you continue reading now, they go and interrogate Calc 3. Candidate says, I agree that each of the 4 aircrafts is a cash generating unit based on the definition of the CGU, the smallest identifiable assets, group of assets that can produce cash flows on their own. We've correctly complied with the requirements to perform an annual assessment of the potential indicators of impairment and perform an impairment assessment if an indicator is found. The recoverable amount of the aircraft is only determined using the value in use and not fair value less cost to sell. IAS 36 says we must determine the fair value less cost to sell as well as the value in use and use the higher of the 2. Happy to give the candidate benefit there for identifying that the fair value less cost to sell was not then considered. Then they say we should perform an assessment of the fair value less cost to sell in terms of IFRS 13, which provides principles on the fair value measurement. I'd require more information to perform this assessment. So no real benefit there. I think the point with the fair value less cost to sell was the fact that it was omitted from the calculation. IFRS 13 is going a bit too far for this task. Then it says impairment cost is correctly calculated using the recoverable amount less carrying amount please see considerations on the carrying amount and the recoverable amount. The right of use asset that is used should only relate to the right of use for one aircraft and is correctly determined using the carrying amount of the right of use asset as per the statement divided by 4. I mean, here, they're just validating the right of use value that's given there, so no benefit there. Then the vehicle, furniture, and equipment that is included should only be included if the aircraft cannot generate cash flows without these. Would require more information on exactly what these assets relate to. However, I think that it is highly likely that the aircraft can generate cash flows without these, and these are then incorrectly included. Then they go and apply and they say leasehold improvement that's included should only be included if the aircraft, for the aircraft that is being impaired, these are correctly included in the calculation. Trade and receivables are incorrectly included in the carrying amount of the CGU, as these do not relate to assets used to generate cash flows. And then they have the same comment for the cash and cash equivalents. So we were happy to give, if you read all of those 4 bullet points together, we were happy to give the consideration for the composition of the CGU. So they are really questioning, should these be in the CGU? And they've given us reasons why they've got an issue with that. Then we've got the value in use, where they then say, I require more information on how the cash was determined. So I'm happy to give them more information. And then they say this should be based on management recent forecasts and should only include cash items. So I'm happy they want more information. They want more information to the value in use for the value in use calc, and they're telling us what information they need. They need the recent forecasts. Then they say it's unlikely that the cash flows will remain constant for the entire period. We should incorporate cash flows per period with the consideration for inflation and use. So once again, quite happy to give this because they are questioning the composition of those cash flows, and they've given us examples, and they told us that you use the same amount every period. This is not valid. And then they say cash flow should exclude cash flows from financing and income tax. So once again, this is now theoretical. If the candidate says, I've got a question, I'm not sure if the cash flows you've used exclude interest and tax, I think we're happy to give it, but this is a very theoretical statement as it stands. Then they say cash flow for 10 years is incorrectly used, as IS 36 prescribes that it must be a maximum of 5. We need more elaboration here, because remember we've got 7 or 8 years left of this lease. So 5 years would not cut it. Would you then have a terminal value of 2 to 3 years? But because the period is also 7 or 8 years, depending on which way you went, maybe the projection should be 7 or 8 years then. So I'd want a little bit more in terms of this bullet point. Then they say the discount rate is prime. We need to consider whether the rate accurately reflects the risk for this asset. The rate implicit in the lease would be more appropriate. So quite happy with this. They're questioning the nature of the rate, so definitely giving a benefit there. Then they say the adjustment to the discount rate to exclude tax is correct. So that is now an issue, because the adjustment to exclude tax. So I think we had a very big discussion about this, because excluding tax could mean you are taking tax out, or you are just ignoring tax. So for this candidate, I think another point maybe which will be valid at this point to bring across is just to make sure that you do read your responses to make sure they make sense, because this exclude tax is incorrect. I think it should then be incorrect instead of correct. So if you look at this, the candidate has been able to, if we look at the items they've identified the residual value. They've got 2 points on residual value. In terms of the useful life, they've got 2 points where they've had the flying hours, and they also have the incorrect period used in the calculation. Then for maintenance, they also have 2 points. They identify the expenditure, they identify the capitalization of this maintenance. Then if you keep reading, there's the fair value cost to sell that they've identified has been omitted. They have vehicles, or the composition of the CGU is being questioned with reason. The candidate goes and asks for additional information, because that's one of the requirements. If you want more information, ask for information. So ask for additional information and given us what information they need. They then talk to us about the nature of the cash flows. They're unlikely to remain constant. Then they talk to us about the nature of the discount rate. So this candidate has sufficiently demonstrated competence. They've addressed all 3 calculations, number 1. And number 2, they've addressed sufficient points to say that they have demonstrated competence. This candidate for task B is also graded as a C. So if we look at candidate G, task B, so this candidate has an interesting response. It's in a table. So there's some salutations. And they say the depreciation calculation should not be calculated for each component of the leased aircraft. And so the depreciation should be calculated on the right of use as a whole. So this point that they've got, and I mean, they link it back now on this side to talk about, you know, the lease should be depreciated on the cost of the right of use asset, which includes the measurement of the right of use asset, and they've got the direct cost. So in reading this, you could say, okay, perhaps the candidate is going on the tangent of saying, you know, why are you compartmentalizing this? But this is very light, because we would need further discussion or explanation that shows that the candidate understands that a right of use is very difficult to have components. But I mean, we could then give benefit over them. Then the candidate says the cost of the asset does not seem to be the correct values. As previously stated, the right of use asset should be depreciated. Then they link that to say the cost of these values do not correspond with the draft financial statements of 2023, were there any additional assets that were acquired. So we were quite happy with this, because they've identified that the numbers in the calc and the numbers in the financial statements do not correspond. Then they talk about the useful lives. Just check. Then they talk about the useful lives of the leased aircraft are different values. IFRS 16 requires a right of use is depreciated over the length of lease of the term. So I'm not giving anything there. But they say the depreciable amount of all the assets was estimated at 80% of the cost. This does not seem correct. A residual value should, according to this, according to the specific lease agreement applicable to the lease asset. This is not correct, ladies and gents. Why? Because they want to link the residual value to the lease agreement, which is not the technical that we are looking for then. Then where's the calculation on the amortization of the leasehold improvements and the depreciation of vehicles and furniture and equipment? Leasehold improvements should be calculated and amortized over the remaining length of the lease contract from the date when the lease improvements were made. Depreciation of vehicles and furniture seems not to be included. But remember, we were depreciating the right of use asset and not the CGU, so that's not valid. Then they say initial treatment of the maintenance costs seems to be correct. However, there could be allocation entries that were generalized throughout the year because maintenance expense is less than the forecasted figures, not valid. What is the reason, or why is the maintenance cost that is summarized in the GL less than the forecast? So we're not happy with this. These are not valid points. Then they talk to us about repairs and maintenance in terms of PPE, and then they say the general ledger must be scrutinized and any potential capitalized items identified or confirmed only as maintenance. The classification of assets would be based on the type of maintenance performed. Major maintenance programs carried out as part of the periodic inspection overhauls, and that results in a future economic benefit beyond those initially expected may qualify as an asset. This candidate doesn't land, so we're not giving the maintenance cost here, because this you can actually conclude on the maintenance costs in this task. Then in terms of Calc 3, the impairment, they say, I agree that each aircraft is a CGU as identified in IS 36. CG is the smallest identifiable group of assets that generates cash flows independent cash flows, which is each leased aircraft. So that's not a valid point. They should actually be talking more about the lease agreements. Then the trade and receivable was incorrectly included. Trade and receivable should not be added to the calculation because they're already at fair value. That is the incorrect justification. They can then say not necessary because it's unlikely to only relate to this aircraft. They could then question the fact that, okay, unless you've also included the cash flows from trade and receivables in the VIU, the value in use, then you can include them there, but otherwise they should be excluded. So definitely not a valid consideration given here. Cash and cash equivalents incorrectly included in the calculation also says that fair value. Also, this is the wrong reason. So then he says the annual cash flows were not taken into account. The annual cash flows must be taken into account in order to determine the value in use. The value outflows. The costs include fuel, but then this is not valid because the calc did use cash inflows and cash outflows. I think the candidate misinterpreted the information because it said net, it's basically the number that was given there was showing that it's a net cash inflow. So this would not be a valid consideration. The residual value per the impairment calc is 0. However, in the depreciation calc, the residual value is 20%. The question that I'd like to verify is what are obligations in terms of the lease agreement? Do we have to return the aircraft in a certain condition? What will be the fair value of that condition so that we can determine if there's a residual value? Once again, this is the incorrect application of the definition of a residual value. So no valid points there. So the African prime rate is not the correct rate. In the latest financial data I have available, the prime rate is that. Remember, the prime rate is not necessarily the correct rate because it's not reflective of the risks associated with that asset. So definitely not a valid point. And then the fair value cost of sale is also not included in the calculation. It means that the calculation is not complete and that the recoverable amount could be incorrect. The recoverable amount is the higher of the fair value cost of sale and the VIU. I would have you obtain the fair value. So I'm happy to then give the fair value less cost of sale that I provided. Then they talk about a terminal value that's not correct. Terminal value should include the risk-free growth rate, the prime rate, stated in the calculation is that, however, 8.2 is used. We need to ask the following questions. Was there perhaps a mistake in that design? So I don't think this is a valid point, ladies and gents. It's talking about terminal value, but then they go and they talk about, yes, I mean, some of this will help us determine the terminal value, but the crux of the discussion here is about the rate used in the question. So no valid consideration given there. The value in use is not correctly calculated. There was no net present value determined of the future cash flows or calculation performed based on forecast provided by management. In measuring the value in use, an entity shall base cash flow projections and supportable assumptions that represents management's best estimate of the range. So, I mean, also not a valid point. I'm not sure what the critique point is here. And they're saying not correctly calculated. How do we know it's not correctly calculated? So, I mean, talking to the fact that the cash flows are the same each year maybe would have been a valid example of application in that instance. The residual value should be based off financial forecast by management. The projections must only cover a maximum of 5 years. We are happy with this, but remember, we can use the 7 or the 8 years. I'll send you to then incorporate that terminal value as they were discussing. But I mean, this discussion they have on terminal value is not landing as they are discussing more about the cost or the interest rate used to discount those cash flows. So overall, this candidate, ladies and gents, I mean, they've got the fair value less cost to sell. If we scroll up, they've got the numbers not corresponding to the financial statements. And then they've also got, whether the component approach is applicable or not. I mean, if you really look at this, the candidate has 3 valid aspects in the midst of everything they've given us. And overall, then, this candidate was then graded as limited competence. Once again, I hope this has been helpful and good luck for 2024.